Welcome to the SmartKeys podcast. Right now, the financial institution holding your company's money has this hidden carbon footprint.
Yeah, a massive one.
Exactly. And it is roughly 700 times larger than the electricity they use just to, keep their own lights on.
A crazy statistic.
It really is. And global regulators are actively forcing them to clean it up, which means those banks are about to heavily scrutinize your business next.
Right.
So we're undergoing this massive fundamental rewiring of how money moves around the planet. And the rules of the game are basically being rewritten while we speak.
Yeah, it is a profound shift, really. I mean, we are moving away from an era where environmental initiatives were essentially just corporate public relations.
Yeah, just PR.
Exactly. And now we're entering a phase of hard financial mechanics, strict compliance, and just massive capital reallocation.
And that brings us to your mission for this deep dive. We want to help you, the listener, shortcut the learning curve on this huge economic shift.
Because you really need to know how these changes are going to impact your quarterly budgets, your procurement requirements, and even your capital expenditure requests.
Absolutely. So to do that, we are extracting the most critical insights from a highly comprehensive article on smartkeys.org. It's titled Green Finance Trends, Investing in Sustainability and Growth, and it's written by Felix Römer.
Yeah, it's a great piece.
It is. We are looking past the, superficial buzzwords to uncover the real strategic insights, the practical tools, and those shifting financial levers that modern professionals just have to understand to stay competitive.
And Romer's analysis is vital here because, well, he treats this transition not as some environmental plea, but as a rigid financial reality.
Right.
If you are managing operations or supply chains or corporate strategy and you don't grasp the mechanics of these capital flows, I mean, you will find yourself locked out of the most favorable funding markets.
Okay, let's unpack this because the sheer mind-boggling scale of the money moving around right now is where we really have to start.
The numbers are huge.
They're absurd. We are well past the point of niche investments here. According to the article, global capital flows into sustainable projects have just absolutely exploded.
Yeah.
Like back in 2012, market issuance was sitting at around $5.4 billion. But fast forward to 2021, and that figure skyrocketed to $540 billion.
Which is, a 100-fold increase in less than a decade.
Wow.
What you really have to focus on is the underlying catalyst here. This isn't driven by sudden corporate benevolence.
Right. It's not charity.
No, it is driven by hard math. The Intergovernmental Panel on Climate Change, the IPCC, they've mandated a 43% emissions cut by 2030 to stave off the worst-case scenarios.
Okay.
So translating that into financial terms, investment roadmaps estimate the global economy requires roughly $4.35 trillion annually by 2030.
Wait, trillion with a T?
Yeah, trillion.
Yes.
And when we look just a bit further to 2035, that cumulative requirement hits around $53 trillion.
Trillions every single year. I mean, it's a scale that literally alters the foundational plumbing of global markets. And this reallocation of capital, it's actually formally baked into international treaties now. Like the article specifically points to Article 2.1c of the Paris Agreement.
Right, the Paris Agreement.
Yeah, and it doesn't just suggest, but it explicitly pushes to make all global finance flows consistent with a low-emissions, climate-resilient path.
And that specific clause, it acts as the ultimate policy signal. It essentially tells institutional investors that high-emission assets will inevitably become stranded assets.
Right, they'll lose all their value.
Exactly. But as this money moves, the financial sector has had to build a completely new vocabulary to route it correctly. So the United Nations Environment Program, the UNEP, they established these vital distinctions.
Okay.
They categorize this capital into 3 distinct tiers. You have climate finance, green finance, and sustainable finance.
And I think, honestly, a lot of professionals use those terms interchangeably in meetings, just assuming they all basically mean good for the planet.
Oh, constantly, yes.
But legally and structurally, they are incredibly different.
Yeah, distinctly different, yeah. Climate finance is highly targeted. I mean, it is capital specifically earmarked for projects that directly reduce emissions or adapt to localized climate impacts.
Okay, so very specific.
Very. Then, green finance casts a slightly wider net. It includes climate mitigation, but expands to cover broader environmental objectives, things like biodiversity protection or water conservation.
Got it.
And then finally, you have sustainable finance, which is the broadest category of all. It encompasses the environmental factors, but deliberately integrates the social and governance frameworks. So your classic ESG criteria.
It reminds me of setting up API endpoints in a complex software ecosystem.
Oh, that's a good way to look at it.
Right, like if your business is broadcasting a sustainable data packet, maybe you have great labor practices and diverse governance, but the institutional investors compliance system is strictly querying for a climate finance endpoint with hard measurable carbon reduction metrics. Well, the connection just drops.
Yeah, exactly.
The capital doesn't flow. You've brought the wrong structural data to the transaction, which inevitably leads to this huge mismatch in stakeholder expectations.
What's fascinating here is that mastering this precise terminology is really a company's first best defense against greenwashing accusations.
Oh, so?
Well, it forces you to align your capital strategy with your actual operational mechanics. For instance, if you are applying ESG integration, you're generally doing that as a defensive mechanism, right?
To protect the bottom line.
Exactly, to achieve better risk-adjusted returns by pricing in long-term societal shifts. But if you are pursuing impact investing, you are playing offense. You are intentionally seeking out measurable external outcomes alongside your financial return.
Right.
Blurring the lines between risk management and impact generation is where companies get into serious trouble.
So understanding the API endpoints of this new capital is basically step one. But that naturally brings up a highly practical question for you, the listener. How do you actually access this money?
Yeah, the real question.
Right. If we open up the so-called green toolbox, what instruments are actually sitting inside?
Well, we are seeing rapid product innovation across basically every level of the economy. Let's start with everyday consumer and business banking. Lenders are actively rewarding efficiency because it genuinely lowers their default risk.
Okay.
The article notes lenders like NatWest in the UK who are offering notably reduced mortgage rates for properties that achieve high energy efficiency ratings, specifically EPC A or B.
And you see this rippling through other consumer debt markets too. Like U.S. auto lenders are structuring highly favorable, much longer-term loan terms specifically for electric vehicles.
Yeah.
You even have financial products like the Aspiration Zero credit card, where the interchange fees from everyday spending are directed entirely towards certified tree planting projects.
Yeah.
But let's scale up for a second. If you are a corporate treasurer or a project developer, what does this actually look like?
At the macro level, green bonds are the dominant instrument, and the volume growth is just staggering. The market for these labeled bonds expanded from about $170 billion in 2018 to roughly $523 billion by 2021.
Wow.
And mechanically, you really need to understand the difference between the two primary structures here, which are use of proceeds bonds and project bonds.
Okay, let's actually dig into how those function differently for a business.
Sure. So if your company issues a use of proceeds bond, the capital you raise goes straight onto your general corporate balance sheet. But you are legally bound by covenants to allocate an equivalent amount of funds to eligible green categories across your entire portfolio.
So you have some flexibility.
Yes, you have flexibility in execution, but you also have heavy post-issuance reporting requirements. A project bond, conversely, ring-fences the capital entirely.
Oh.
The money never even touches your general ledger. It is strictly locked to the development of one specific asset, like, say, a new offshore wind farm. It offers investors much clearer security and highly distinct reporting lines.
And we are also seeing massive pools of liquidity forming in public equities and community initiatives, too. I mean, the European market for ESG and climate exchange-traded funds has already blown past $640 billion in assets.
It's massive.
It is. Meanwhile, in the U.S., community development banks are quietly becoming a powerhouse. Like, between 2011 and 2020, the number of these specialized banks grew from just 1 to 21, and they managed to funnel around $7 billion directly into localized clean energy projects.
Yeah.
And that's paired with major federal incentives, like the EPA's Clean Water State Revolving Fund, which offers deeply subsidized loans for municipal infrastructure, and tailored SBA loans designed specifically to help small businesses pivot to clean tech.
Exactly.
But wait, let me push back on this entire system for a second.
Sure.
We're talking about hundreds of billions of dollars chasing a limited supply of truly transformative projects. If the demand from investors is this rabid, aren't corporate borrowers just finding loopholes? Taking a standard everyday loan, slapping a green label on it to secure a cheaper interest rate, and basically just continuing business as usual.
Well, the empirical data entirely validates that skepticism.
It does.
So absolutely. The article explicitly highlights that the bond markets have faced notable systemic greenwashing risks. I mean, when disclosure relies purely on voluntary good faith, the market inevitably trends toward exaggeration.
So how does an investor or a business partner actually trust any of these financial instruments?
Well, they don't rely on trust, right? They rely on verification mechanics.
Yeah.
This is where blended financing structures come into play.
Okay.
By combining public foundational dollars with private capital, you inject multiple layers of distinct underwriting scrutiny into a single project. Furthermore, the market now aggressively demands second-party opinions.
Meaning what exactly?
Meaning, you can't just declare your bond is green. A specialized external auditor has to verify your framework before issuance, and then you are bound to rigorous, standardized impact reporting afterward.
Which is really the perfect friction point to explain our next major shift. Because investors were getting burned by these exaggerated claims, global regulators frankly panicked.
They did.
To stop the flow of fake green assets, they decided to completely rewrite the rules of the market. They are moving away from voluntary guidelines to really aggressive, mandatory frameworks.
And this is where the compliance burden gets very real for operations teams. Initially, the market relied on voluntary frameworks to build trust, things like the ICMA Green Bond Principles and the Climate Bonds Initiative.
Right.
But voluntary just wasn't enough. So the European Union stepped in with the European Green Bonds Regulation, the UGB, which formally entered into force on December 21st, 2024. The UGB is a watershed moment because it forces any bond using the label to align strictly with the EU taxonomy.
And the EU taxonomy is essentially the master dictionary for what legally qualifies as sustainable in Europe.
Exactly.
It rigorously tests economic activities against 6 highly specific objectives: climate mitigation, climate adaptation, circular economy, pollution prevention, water resources, and biodiversity.
Right.
If an activity doesn't substantially contribute to one of those while doing no significant harm to the other 5, it simply fails the test.
It is an incredibly dense scientific framework.
Yeah.
But defining green at a macroeconomic level is just fraught with technical disagreements.
Oh, for sure.
The article details a massive ongoing controversy regarding whether fossil gas and nuclear power should be included in that taxonomy.
And it's crucial we look at that debate purely through the lens of the source material here. We aren't taking a side on the politics of energy.
No, not at all.
The core issue is that expert groups clashed heavily over the actual data. One side pointed to the severe risks of upstream methane leaks and the unresolved challenges of nuclear life cycle emissions and waste.
Right. And the opposing side argued that without the baseload stability of nuclear or the transition capacity of gas, the broader grid simply cannot bridge the gap to renewables fast enough.
Exactly. And regardless of who is scientifically right in that debate, the article makes it clear that this regulatory tug-of-war creates a nightmare of cross-border complexity for international investors trying to build compliant portfolios.
It does. And because cross-border investment is so complex, regulators are standardizing how companies must disclose their internal data. For years, the gold standard was the TCFD, the Task Force on Climate-Related Financial Disclosures.
Okay.
It was voluntary, and it was built on 4 pillars: governance, strategy, risk management, and metrics. It really helped companies structure their internal narratives.
But a structured narrative just isn't going to cut it anymore.
Yeah.
Enter the CSRD.
Yes, the Corporate Sustainability Reporting Directive. Adopted in October 2022, the CSRD fundamentally alters corporate accounting. It forces mandatory, highly detailed reporting for roughly 50,000 companies operating in the EU. And the most disruptive mechanism it introduces is this concept of double materiality.
Let's explain how double materiality actually changes the day-to-day reality of a mid-level executive.
Okay.
Previously, you only had to report on financial materiality, meaning how does a changing climate affect your company's bottom line? Like, will a flood destroy your factory?
Right, traditional risk.
But under CSRD, your accounting department has to calculate the exact opposite as well. They have to audit how your business activities impact the environment and society.
Yeah.
Suddenly, your finance team isn't just looking at supplier invoices. They have to calculate exactly how much local river water your supplier used to manufacture the widget you just bought. It quite literally turns traditional accountants into environmental auditors.
It forces total supply chain transparency. And this absolutely ensnares U.S. and multinational firms too. I mean, if you have significant operations or subsidiaries within the EU, you are legally pulled into this mandatory reporting net.
Here's where it gets really interesting. It's not just government regulators demanding these reports, it is the central banks.
Yes.
We often think of central banks as the referees of the global economy, making sure the game is fair. But right now, They are actively changing the rules of the game to favor one side of the field.
Oh, completely.
They are fundamentally altering credit terms and access to capital based on climate data well before the broader market fully realizes the shift.
Referees is one way to look at it, but their actions are actually much more akin to the casino house deciding to change the value of the chips on the table.
Oh, I like that.
Yeah. The Network for Greening the Financial System, the NGFS, is the prime example here. It is a coalition of 116 central banks. They are actively running climate scenario analyses and stress tests that establish the foundational supervisory expectations for every commercial bank beneath them.
Wow.
And the European Central Bank, the ECB, is taking it a step further by deploying aggressive monetary policy tools.
So what mechanics are they actually using to change the value of the chips, as you put it?
They were heavily utilizing targeted collateral frameworks. Think of the central bank like a massive pawn shop for commercial banks.
Okay.
If a commercial bank brings a standard fossil fuel loan in as collateral to borrow cash, the central bank might apply a penalty haircut, giving them only, say, 70 cents on the dollar.
Ouch.
Right. But if that commercial bank brings in a certified green loan, the central bank gives them preferential treatment, maybe offering 90 cents on the dollar.
Oh, wow.
Yeah, by artificially making green capital cheaper and easier for commercial banks to leverage, the ECB forces those banks to lend more aggressively to sustainable businesses.
That is incredibly direct.
It is. They're also exploring green refinancing operations and targeted quantitative easing to directly soak up sustainable asset issuance.
So they're just buying it right off the market.
Exactly. And if we connect this to the bigger picture, reading these central bank communications early provides you with a massive strategic advantage. Well, as Römer points out in the article, when central banks signal these structural changes, they alter technology cost curves. They take vague 10-year pipeline projections and turn them into immediately investable deals simply because the cost of capital suddenly drops.
But all of these sophisticated central bank mechanics, all the blended finance structures and the stringent taxonomies, they all hinge on one absolute necessity.
Yeah.
And it happens to be an area where the vast majority of companies are currently failing. The data.
The data blind spot is unequivocally the greatest vulnerability in the modern financial system right now.
It really is. The source material highlights a truly staggering metric. On average, a financial institution's financed emissions contribute a footprint that is roughly 700 times larger than its direct operational emissions.
700 times.
Yeah. So when a major bank pledges to go net zero, changing the light bulbs in their headquarters or grounding the corporate jets is, frankly, a mathematical rounding error.
A total rounding.
The actual carbon footprint of the bank is the combined emissions of every single factory, shipping fleet, and energy project they have issued a loan to.
Precisely. The indirect financed impact entirely dwarfs the direct operational impact. Yet, despite that massive discrepancy, the reality on the ground is dismal.
Yeah, it's not good.
Roughly 75% of the financial firms reporting to the CDP do not actually report their financed emissions. It is a gaping systemic hole in global data.
And to fix this, the industry is moving toward PCAF methods, right? The Partnership for Carbon Accounting Financials.
Yes.
It's this open source methodology that allows banks to calculate their portfolio level emissions based on their proportional loan to value investments, making those numbers standardized and auditable.
Exactly.
So what does this all mean? Why should you, the listener, who might just be trying to optimize your own company's procurement strategy, care about how a mega bank uses PCAF methods to calculate their financed emissions?
This raises an important question, and honestly, it is the ultimate takeaway for anyone navigating this transition. Closing these data gaps is no longer just a regulatory compliance exercise for the banks. It is a strategic imperative for you.
Why?
Because central banks are squeezing commercial lenders to clean up their portfolios. Right. So those commercial lenders are immediately passing that pressure down the chain to their corporate borrowers. If your business cannot provide clear, standardized, auditable emissions data, the bank has to assume you are a high-risk asset.
And they price your loan accordingly.
Exactly. But if you can deliver that data seamlessly, you instantly lower your own capital costs. You become a highly attractive de-risked asset for them to invest in. Emissions data is rapidly becoming just as critical to your survival and expansion as traditional financial accounting.
It's a completely new ledger that dictates your access to liquidity.
It is. The next decade will be defined by trillions of dollars flowing out of legacy systems and into long-lived transformative projects. Things like massive grid modernization, scaling utility-level battery storage, implementing deep industrial efficiency upgrades, and total fleet electrification.
It's a total overhaul.
Capital and climate goals are finally lining up in the same direction. The businesses that will thrive over the next 10 years are the ones that position their strategic roadmaps to capture this secular growth, while remaining agile enough to navigate the volatility of, evolving taxonomy policies.
It fundamentally changes how you have to structure your business. You have to learn how to combine public incentives with private partners, structure your data to meet exact regulatory endpoints, and then use that transparency to lower your cost of capital so you can move your operational plans into construction faster than your competitors.
Yep.
The financial landscape isn't just updating its public relations strategy. The foundational operating system of the global economy has been rewritten.
Completely.
Before we wrap up this deep dive, we want to leave you with a final thought to ponder, building on everything we've explored today.
Yeah, let's hear it.
We discussed how financed emissions act as this massive hidden shadow footprint for the financial sector, a footprint 700 times larger than what they directly produce.
Right.
So take a hard look at your own daily operations. What hidden, indirect impacts exist deep within your own industry's value chain?
That's a great question.
What shadow footprints, whether it's water usage, offshore labor practices, or Tier 3 supplier emissions, are sitting out there right now, completely unmeasured today, but will inevitably require strict auditable accounting tomorrow?
Because they're coming for that data.
Exactly, because the central banks and regulators are already rewriting the rules, and the businesses that measure and manage that shadow footprint first will be the ones that dominate the market.
Identifying those blind spots early is really the key to unlocking the massive capital flows we've discussed today.
Thank you so much for tuning in to the SmartKeys podcast. If you found this deep dive valuable, please make sure to subscribe to the podcast so you never miss an update on the hidden mechanics and strategic trends shaping the future of business.
And definitely check out the article.
Yes, we highly encourage you to read the full, comprehensive article by Felix Römer to truly grasp the nuances of these financial tools. We've placed the link to the original piece right there in the show notes for you. Until next time, keep exploring the insights that help you stay ahead.